Hello everyone, this is Roy. I'm the founder of Olivon Investments. You can visit our website at olivon.com. That's AALAVON.com. I'll leave for those of you on YouTube, I'll leave a link in the description below. I just wanted to get on here and make a quick video about stocks float, sort of explain what it is. All right, when you look at a stock, one of the first things you're going to notice is the market cap. That's the total shares of the company. And so let's say a company has 100 million shares. That'll be the market cap. That's all the shares put together. And then the company's float is how many of those shares are outstanding for the public to buy and sell on a day-to-day basis. And this sort of breaks down the difference of it right here. So a company might have 100 million shares. However, only maybe 10 million of those shares might be the company's float. So there's 10 million shares on any day. They're just out and about, floating around, that the public's buying and selling. So some of the ways the float comes to the market is through normally an IPO, which is an initial public offering. This is what a company puts out when it first decides to go public. It puts all its shares on the open market. They can also do this through, it's less common, but through a direct listing. For smaller companies might choose to do a direct listing. And I might want to look at this. Less people know about it. And okay, let's see. Another thing that can affect the float is the company can buy back shares. So the float isn't set in stone. This float can change. The companies could buy back some shares. So they could that same company could buy back half the shares, and the float would go down to only 5 million. Or they could do a secondary offering. They could release an S3. They could do a secondary offering, and they could put more shares out on the open market if they needed to raise money. Of course, that sort of dilutes the stock. It's wonderful news if you're a short seller, if they're having a secondary offering, because that generally means you could short the stock because there's a good chance the price is fixing to fall. A company can also do what's called a stock split. That's where you have normal splits and you have reverse splits. Let's say you own 10 shares in a company and the stock splits. Well, it just does like a 2-for-1 split. It can be 2-for-1, 3-for-1, 100-to-1. It can be anything like that. Let's say it's a 2-for-1 split. So instead of you owning 10 shares, let's say they're valued at $100 each. So instead of owning 10 shares that are worth $1,000, now you own 20 shares. However, they're still worth $1,000, all combined. So instead of being $100 a piece, well, now they'd be worth $50 a piece. But you own 20, so it adds up in that manner. And they can also do a reverse stock split. Let's say they just wanted to. There's certain listing requirements, for the New York Stock Exchange, and to stay listed, they have to keep their stock price above a certain level. So they might do what's called a reverse split. So and if the company did a reverse split, then instead of owning 10 shares at $100 each, then you would own 5 shares, and they'd only be worth $200 each. But it all the immediate effect, is you're generally how much. The value generally doesn't change. It's just the number in your portfolio changes. Being day traders, the float's really important to us. We don't want it to be crazy high, but we need enough liquidity. We need enough going on to be able to get in and out of the trade. This is what a gap scanner looks like. This one was taken, looks like it was captured sort of around lunchtime, so this probably isn't the best example. But this is generally, what a day trader would look like when they first sit down in the morning before the bell rings at 9:30, Eastern time. This is something we might see around like 9 o'clock or something like that. And it's just a list of all the stocks that are gapping up. See, these are like this. The top stock on the list is gapped up 258%. So this thing was probably, so it was probably trading like a third of that or something yesterday. Here's a stock gapping up 108%. And of course, getting down the list, I wouldn't even. Honest to God, normally I wouldn't go past the first, really 2 or 3 of them, and that's kind of iffy right there. It's just that sometimes there's nothing going on, so you might look at something like that. But with the price and everything, honest to God, the second one here, if it was the morning, which it isn't anymore, but this one is the only one that really looks, halfway decent. And a lot of it's just because the prices are low. But anyway, getting back to the float. That isn't ideal, but normally you would want to look for something like under like 30 million shares, under 20 million, 30 million shares. Really lower than that, but you want it to have like at least like a couple million. Like you want to I personally want to be able to look at the pre-market and not see just like a bunch of dots all over the place. Like I should have brought up a chart. But you don't want to look at the pre-market and look like you're seeing stars everywhere. You want to see candlesticks and you want to see some action. Let's see. Yeah, I guess that's about it. So that's a big thing we do is we look at the float. Once again, this is Roy from All of Our Investments. You're welcome to come to our website and check us out. I'll leave a link below. If you stay tuned, I'll probably be doing future videos, and we'll go over the float a lot more. You'll hear a lot about the float. All right, thank you.